Within that monetary metal grouping, silver has broken out versus gold. So it's telling you, yes, you should be in the monetary metals, one form or another, but you really should be more in silver. Silver looks like now it's going to beat gold handily. So if gold goes up another 50%, silver, off the page, why can't silver do the same? If it did, it'd be $200. Because if you go back and measure, like silver in 1980 was 50, okay. Silver in 2011 was 50, okay. Let's deflate, let's take the money aspect out of that.
Michael Oliver reveals silver's breakout above $62 signals a historic shift, an era of silver prices to explode, becoming 50% to gold. After 11 years of trading sideways against the S&P 500, gold, silver, and miners have broken out into a new era of outperformance. Silver specifically is set to beat gold in a breathtaking way. Citing copper's explosive 2005 move, Oliver warns silver could see a tantrum, a violent, non-incremental leap to a new reality, potentially reaching $200 to $400 when adjusting its 1980/2011 highs for dollar debasement. A 2026 stock market crash and relentless government money printing will be the accelerant. The decades-long price suppression has created a compressed bomb ready to explode. Subscribe to Fine Metals for future updates.
What's the degradation in the US dollar in terms of quantity per decade growth? Okay, silver would be $200, 300 or 400 easily, just to match those highs. Silver is both a monetary metal for thousands of years, like gold. In fact, India is moving toward monetizing silver now. But it's also very undervalued to gold. If you go back like the last 50 years, we're trading in the US of gold and measure silver versus silver in 20 of those 50 years was at least up to 2% of the price of an ounce of gold. Okay, right now we're 1.4%. Okay, very low. But in bull years, like in 79 and 80, when silver went up to the top of that old range, $50 highs, and in 2010, 11, when it went up to 50, it got up to 6.5% price of gold and 3.5% of the price of gold. Right now, we're 1.4. We're in a bull market. If silver goes and does what it did back then, you could see it double to triple its value relative to gold. It was late 2024, early 2025, it was making highs, NASDAQ 100 or S&P 500. And then came that headline sell-off. And that's what if you're a bear, you do not want a sell-off that has a headline attached to it. And they can't figure out, why is it going down? Because if everybody has a headline attached to it, usually it's a trap, okay? Meaning it's going to go back up again. So sure enough, Trump waved his wand in mid-April after we had a 22% S&P drop, pretty fast, March and April. And we got to a level where our reports, momentum structural analysis, said, okay, we thought the sell-off was going to occur, but right here around 4,800 on the S&P, which again was a 22% drop, it turned and burned back to the upside. Don't expect it to occur incrementally. Anyway, well, they will be. And when events like stock market downturns plus the associated data negativity points that occur, all of a sudden unemployment just doesn't inch up, it shoots up. Factories shut down, et cetera. You name it. All these metrics that the central banks like to assume are licenses to kill. They can do what they want now, okay? They'll do it. In which case, the increase in the monetary degradation will even more accelerate as they panic. And the prime beneficiary of that has always been what? Gold, period. Okay, it always holds its value against degrading money units. So, the stock market rolling over is an assist. Gold's already done this without the stock market rolling over. But, when it does roll over in a serious way, gold will have a huge fuel injection. Did it twice, the 1980 peak and then 2011 high. They were both eightfold. We're only fourfold from our bear low. Our bear low was in 2015, at $1,046. So we're 4,000. Okay. So if you look at your simple price chart, you say, golly, that looks, I got to take profits. I'm nervous. It's only begun. Now, we think ultimately those old highs, the eightfolds, that was a norm. I mean, you did it twice under conditions that aren't anything like what we're going to face or are facing. So to expect it to go there is no big deal. The issue is it going beyond? Now, and they did it because Trump said, oh, we're going to hold things off for 90 days. So, in other words, the headline that took you down, he sort of shoved it aside for a while. And so it's like a bunch of headline chasers. Chase it down. Oh, chase it back up. It's like little puppies. Okay. Anyway, but that kind of action, and we made marginal new highs, like 10 or 12% in the S&P. Some sectors didn't make new highs, but okay, pardon me for being long-winded. That's the way stock markets top. If you go back to 2000, the dot-com or the real estate top in 2007, it was a whole year of laborious, boring, can't quite interpret it type action. So nobody was scared, and yet you were topping. But we did the same thing this year. We went up and took out the high we made early in the year, and then we've gone nowhere for about 3 months now, just doing spinning our wheels. That sort of surprised me, not that they turned back up from the level we expected, but that they went and made a new high. But it shouldn't have. It really should not have. So that was, I'd say, if there was one surprise this year, that was it. Okay. You punch on your screen gold or silver, and let's say daily or weekly, and you go back a year or so, it's vertical. So you say, golly, I got to get out of that. I got to take my profits. In fact, if you go back for the 50 years that it's been trading gold, 1975, they legalized it over here. Okay. Anyway, you've had two major bull markets, each of which, if you measure from the bear low that preceded it to the bull market peak, was an eightfold gain from the bear low. So it's all the first three charts I mentioned, gold S&P, gold miners versus the S&P, silver versus all they said, okay, we've now emerged into outperform status versus the so-called great US stock market. Gold and silver has recently, over the last couple of years, in fact, been at very low levels of value compared to the price of an ounce of gold. And so when we plot that chart, you can see it. We just broke out also in November and probably in a breathtaking way during this coming year. And I'm betting on a lot of it occurring by the time we get into the second quarter of the year.
What happened in November? Why did we start to see these changes across those three areas?
No, no, I wouldn't try to find a reason. The reasons exist on a macro level and they recur, over the past century, especially when we've really gone to fiat money, unbacked currencies printed by governments where, the value of the currency unit just continues to decay. You can say, well, what does it cost in euros, or what does it cost in yen, or what does it cost in dollars? Has my stock gone up like it doubled over the decade, let's say? Well, it's a money supply degraded by almost that much. So you're really not making money. So one long human lifetime. And that's about how long the Fed's been around also. Um, this monetary manipulation destroys certain things, like people's ability to calculate their budgets, where they're going to be in a year or two in terms of needed income. All these things change, and sometimes they can change more speedily. Um, and that creates, especially when our stock market turns down, that will be an emotional factor, and we think it's topping. And I think it's going to turn down hard early next year. Once that occurs, people feel pain. And when they feel pain, they get emotional. In other words, right now, everybody can look at their 401k or their retirement account if they've got one, and they're near retirement and they say, oh dear, we're okay. We've got, X amount in our retirement account. If suddenly 20, 30% of that goes by the way, that you can show. And the very first one's on first page of a report we had 2 weekends ago. And it's a simple, almost what you could call an idiot chart. All I do is I divide at the end of every month, and this chart goes back to 2013 when gold was coming down hard. Okay. I plot the end of each month, I divide the price of the front month COMEX future gold into the price of the S&P, and I express it as a percent. Okay, well, it was coming down hard during that gold bear market. And then for 11 years, gold has done this on that chart relative to the S&P, meaning it's had rallies against the S&P, it's sold off against the S&P, but it's gone sideways. Few people realize that for 11 years, gold has really been a par performer to the S&P. Not been a loser, not necessarily a winner. From times it is, sometimes it's a loser relative. But basically, for 11 years, it was like sideways action oscillating. We broke out of that massive range as of November. Now, what does that chart tell you? Anybody with a crayon could draw the green line we've got on that chart and say, my gosh, what a base that is. What stock is that? I'm going to buy it. Okay. Well, it's not a stock, it's a relative performance chart. And it's telling you, it's smacking you in the face. Gold is just beginning a major breakout in relative performance to the great US stock market. Okay. So any assumptions otherwise, that chart's screaming at you, no. There's a chart showing the gold miners versus the S&P. Oops, they also broke out in November on a major base pattern relative performance. And silver did too. Wow. So they're all a chorus. They're all saying, hey, we've just broken out against you. So what those charts tell you is it's only just begun. So people that look at a chart and see gold going up for a couple of years say, oh, that's old. No, these charts say the game just began. It's built up error over and over. Even Jamie Dimon, JP Morgan, said regarding U.S. debt market, which is bigger than the U.S. stock market. So watch it. Okay. This game of government debt rising relative to GDP, and it's like a cyclical thing, goes on for 100 years now. He said you can't keep doing that. Finally, there's a point at which the error has to be dealt with or has the consequences. And there's no sense right now that there's going to be any corrective process on the part of government. Trump wants to, he advocates, he's a free market guy, yet he wants to print, print, print. He's telling the Fed to print. He wants a guy in
What's
there to hold
intervention?
them. Yeah, and take rates to zero, whatever he wants. Well, this is just more of the same, meaning higher yields, lower price. In fact, the recent downside action in the U.S. government 30-year T-bonds don't look good to us. And you drop another about 3 points in that market price-wise, and you could see the bottom come out and hints of panic on the part of the central bank. And these type of things will create events. They're embedded in the errors that are built into these markets' pricing. So if the US stock market is a bubble, which we argue it is, beyond any bubble we've seen in terms of years of gain, percentage gain, it beats 29. It beats 1973 when we crashed into 74. Et cetera, et cetera. It beats them all in terms of longevity and error of pricing. And you say, well, it's because of a good, strong economy. Yeah, right. Look at an M2 chart, money supply. It's like an upward curving arc, okay? And look at Fed funds. They're control the short end of the market. Fed fund rate got up to like 5% recently, and people say, look, they raised. That is one of the lower levels of the last 75 years. It's like in the lower quadrant of interest rate levels going back 75 years. So even that rate rise from zero in 10 of the 15 years, thought everything was okay, guy. And he said, oh, no, it's just due to liquidity. Not that something's really wrong with the U.S. government debt market. It's just liquidity. We need to provide more liquidity. Well, that's a sign of panic on their part. And they never phrase it that way. But you got to watch these big assets like the UST bonds because a lot of people have viewed them as an alternative. Hey, if I don't like stocks, I'll go over to T-bonds. 60-40 principle is very popular. Uh, that's come into doubt lately. I think it was even Goldman Sachs put out a statement saying, hey, it needs to be 60-20-20, 20% being gold. So anyway, these kind of changes occur and they're massive and they're everywhere. They're not just one issue. It's not just tariffs, which is really a new issue. And yet gold's been going up for, since 2015. Do you anticipate the tariff problem? No, that's not the issue. It's the ongoing degradation. If you own gold, smile. Okay, okay, because you're protected.